Welcome to this explainer. Today we're diving right into the math behind systematic investment plans, or SIPs. We're going to break down exactly how compound interest acts as a massive wealth multiplier over long periods of time, literally turning your regular automated investments into incredible returns.
Here is our roadmap for today. First up, bank returns versus SIP returns. Then, the magic of compounding. Next, understanding mutual funds. After that, opening your DMAT account. And finally, starting your first SIP. Let's get right into it.
Section 1. Bank returns versus SIP returns.
Let's face the harsh reality of traditional saving. You stick your money in a standard savings account and you're hovering at what, a 2.5 to 3% return? Even if you lock it away in a fixed deposit, you might hit 7%. But historical estimates for SIPs? They consistently offer a minimum 10% return, and honestly, they frequently go much higher. Now that percentage gap might look kind of modest at first glance, but just wait until you see the underlying math.
Section 2. The magic of compounding.
Okay, let's actually look at the numbers. Say you invest 5,000 rupees every single month via an SIP for 10 years. Your out-of-pocket total? That's 6 lakhs rupees. If you hit that baseline 10% return, boom, you've got 10 lakhs rupees. But what if the market performs well and hits 15%? Your 6 lakhs rupees turns into nearly 14 lakhs rupees. You've literally more than doubled your money in a decade.
But watch what happens when we stretch this timeline out. Same 5,000 rupees a month, but for 20 years instead of 10. Your total investment doubles to 12 lakhs. But your returns? They don't just double. At 10%, you're looking at 38 lakhs. And at 15%? A staggering 76 lakhs. Think about that. You invested twice as much time and money, but your final payout is more than 5 times higher.
So, let me ask you, why? Why does simply doubling the time drastically multiply your final wealth in such an extreme way? Like, what is the mathematical engine actually driving this massive leap from 14 lakh rupees all the way to 76 lakh rupees?
Well, the engine here is compounding interest. See, traditional banks often just give you flat interest, meaning returns solely on your initial deposit. But SIPs, they compound. You earn returns on your monthly deposits, plus returns on the interest you've already accumulated. Over long periods, this creates a massive snowball effect. Compound interest doesn't just grow your money, it fundamentally accelerates time, because your past profits are actively working to generate brand new profits for you.
Section 3. Understanding mutual funds.
Mechanically speaking, an SIP isn't actually an asset itself, it's a discipline. You basically pick an amount, pick a date, and auto-invest directly into a mutual fund. It's essentially wealth building on autopilot.
So where does that money go? It pools together with funds from tons of other investors, and it's managed by market experts. Instead of you sitting there trying to time the market, these seasoned professionals strategically allocate the pool into various company stocks to generate those compounding returns we just talked about, and they just take a tiny commission for their expertise.
And this is exactly where diversification protects you. Take this real-world allocation from an Aditya Birla mutual fund, for example. Your 5,000 rupees doesn't just get dumped into one volatile stock. It's sliced up, 30% in banking, 16% in power, 10% in gas, and so on. So one single monthly payment is instantly diversified, minimizing your risk while absolutely maximizing your growth potential.
Section 4. Opening your DMAT account.
Fortunately, these days we can skip the mountain of traditional banking paperwork. The KYC process is entirely digital and super fast. You verify your contact info with a quick OTP, link your PAN and Aadhaar via DigiLocker, and link your bank with the fully refundable 1 rupee UPI test. Then, you just finish up with a well-lit selfie and a digital signature, and boom, you're in. During the setup, you'll be asked to choose a tier. Now, there is a Premier Pro plan with a $299 fee that gives you lower margin rates for advanced trading, but honestly, if your goal is simply setting up mutual fund SIPs to harness that compounding interest, the zero-cost basic plan is absolutely perfect for you.
Section 5. Starting your first SIP.
There is a massive misconception out there that you need serious capital to start investing. You really don't. A lot of top-performing mutual funds actually allow you to start an SIP with as little as 100 rupees a month. Seriously, just 100 rupees. The main goal is simply to get into the market so time and compounding interest can start doing all the heavy lifting for you.
And hey, if you're worried about locking up your money, don't be. SIPs offer incredible flexibility. You maintain total control of the whole shebang. You pick the exact auto-deduction date. If funds are a little tight one month, you aren't locked into some rigid, unforgiving contract. You can easily pause or skip a payment. And most importantly, if a real emergency pops up, you can withdraw your money whenever you need it.
Now I need to take a quick pause for a very important reality check. Just as our source material mentions, I have to remind you that I am not a SEBI-registered financial advisor. This explainer is strictly for educational purposes, really just to show you how the math and these platforms work. You absolutely must analyze the funds yourself and do thorough research before committing your hard-earned capital.
And as the mandatory regulatory warning explicitly states, investment in securities market are subject to market risks. Read all the related documents carefully before investing. Markets definitely fluctuate, and while historical data points to steady long-term growth, there are absolutely no guarantees in the stock market.
So, we've gone from the low yields of standard bank accounts to the exponential, snowballing power of compounding interest through SIPs. You've seen the actual mathematical proof of how letting your money work for 20 years instead of 10 can absolutely multiply your wealth. So, knowing the sheer power of compounding time over long periods, how are you going to take control of your financial future today?